How to avoid IRS tax audits. On the spectrum of bone-chilling nightmares, the thought of getting audited by the IRS ranks right up there with root canals and being naked in a room full of people. If you could have a bucket list of things you don't want to experience in your life, an IRS audit would be close to the top. What are your odds of getting audited by the IRS? In 2022, the IRS audited, on average, 4 returns out of every 1,000 filed. So, on average your odds are pretty low. But, if you're a low-income wage earner and you claim the Earned Income Tax Credit, you're about 5.5 times more likely to get audited. Is that fair? Absolutely not. But you're easy pickings for the IRS. Welcome to the low-hanging fruit club. What are the other biggest tax audit triggers? Trigger number 1, you have a lot more or a lot less income or deductions compared to the year before. It just looks odd to the IRS, and they think you may be hiding something. Trigger number 2, your business is cash-heavy. When it comes to cash, the IRS has found that many business owners tend to not report all of their income. So your chances of being audited are higher just because you're a restaurant owner, a convenience store owner, a car wash owner, or other cash-heavy business owner. Trigger number 3, the income you report to the IRS doesn't match your W-2 wage and tax statement and 1099 totals. This one happens way too often among the daring or clueless taxpayers who underreport their income, so it's an automatic red flag to the IRS. Trigger number 4, your tax return has math errors. It's like you're pointing your finger at yourself, and daring the IRS to look closer. Trigger number 5, home office expenses. If you're self-employed, the IRS lets you take a deduction for the part of your home that's dedicated exclusively to your business. It's pretty easy to blur the lines here, letting family members use your office, or having another work area outside of your home, or puffing up the actual square footage. The IRS knows this. Trigger number 6, mixing business and personal expenses. You don't keep separate records, credit cards and bank accounts for your business expenses. The IRS thinks you may be using personal funds for business purposes, or using business money for personal expenses. So it's hard to figure out the right tax amount, and the IRS thinks there's a good chance you got it wrong. It's also a trigger if sometimes you use your personal car for business purposes. Trigger number 7, not reporting virtual currency transactions. If the IRS thinks you're not reporting income, your risk of an audit will go way up. Likewise, your audit chances will go up if the IRS thinks you may be over-reporting your losses in order to lower your tax bill. You will probably receive 1,099 forms for any cryptocurrency income, but the IRS can also subpoena crypto exchanges to find hidden assets or transactions. Other tax audit triggers include making more than $1 million per year, using a Schedule C to report business income, having a business that loses money year after year, missing or incomplete tax returns, foreign bank accounts and income, and making big donations to charity, compared to your income. Avoiding tax audits means avoiding the audit triggers we just looked at. The problem is that you may not be able to avoid all of the triggers. Sometimes it comes down to risk versus reward. If you can make $1 million or more, you're not going to give that up just because you will have a bigger chance of being audited. If you're a low-wage earner, you're still probably going to claim the Earned Income Tax Credit if you can, because you can't afford not to. If you're in business for yourself, you don't want to pay taxes on things you could claim as business expenses on a Schedule C. Even so, there are some general guidelines that most taxpayers can follow to reduce their chances of getting audited. Guideline number 1, make sure the income you report to the IRS matches your W-2 wage and tax statement and 1099 totals. Guideline number 2, file your taxes and pay them on time every year. Guideline number 3, keep good records of all financial transactions. This is especially important if you're in a high audit risk category. If you make more than $1 million per year, you should be able to afford to pay someone to keep good records. If you're in business for yourself, and you claim business expenses, a home office, or the use of your personal car, you'd better be able to prove them. Reduce your risk by using business credit cards and business checking accounts, and keeping separate records of your business income and expenses. Guideline number 4, use tax software or hire a tax professional to ensure accuracy and completeness. Guideline number 5, avoid claiming deductions or credits that seem too big to be true. Of course, you want to get all the deductions and credits you can. But, if you want to claim big deductions or credits, be prepared to back it up. Guideline number 6, get professional tax advice, especially if you're at higher risk of a tax audit.
To get help with your IRS tax problems and tax questions, please talk to a qualified tax expert. You can work with a CPA, or other tax professional, where you live. Or, if you'd like to get answers to your questions quickly, about your own taxes, You can chat online now with a qualified tax expert. Just click on the link in the comments below this video.